So I've been receiving a few questions along the same train of thought. Hey Chikeng, I thought Alibaba was supposed to be a quote-unquote value play with cheap valuations. But when I type BABA stock into Google, it actually kicks back this image, clearly showing that Alibaba has a PE ratio of 129. 129, my friend. I then cheekily tweet out some time back that Baba had a PE of 117, Amazon had a PE of 86, and Tesla had a PE of 55. So Tesla is the cheapest. Smiling angel face. So for what it's worth, I'm not providing a buy or sell recommendation on any of the three stocks. And PE ratio is far from being the golden investing truth for trying to determine how cheap or how expensive a stock is. And I have specifically chose the three stated companies for comparison because they each have a unique characteristic behind their mystical PE figures. So you know what else is mystical? The like button. So I heard that once you click on it, you'll see confettis springing out onto your screen. Have a go at it. I promise you'll definitely like it. Now, I hope that after this video, you will have a better appreciation and also a better understanding on how to use the PE ratio in your own investment analysis. First, let's try to dissect the PE ratio. So I know most of you are smart investors. I won't waste too much time here. So PE just represents the price per share divided by the earnings per share. Simple. Theoretically, the higher the PE ratio, the more quote-unquote expensive the company seems. So I use the word expensive in quotation marks because it might not necessarily tell you the full story and the bigger picture. So if you were to judge it from a scientific/mathematics point of view, you can only get a high PE ratio either with a high price or a low earnings per share. So that's looking at PE ratio at face value. So on that same note, the natural question would then be, how do we know if the PE ratio is considered high or low? So I think in order for you to know whether the PE is high or not, you have to compare it to something else. So a PE of 100 might not necessarily be high if the average market PE is 200, for example. So I don't know whether a day like that will ever come, but you probably get my point. So there's two ways to compare. Firstly, you can compare it to an overall index, like the S&P 500 for example. So the last I checked, the S&P is actually currently trading at around 21 times PE. So if you were to pull the timeline back, the S&P 500 has historically been trading around the 15 to 25 times price to earnings range in general, notwithstanding the sometimes huge fluctuations. So in relation to that, if your company has a PE of more than 30 or 25 for example on a consistent basis, it might mean that the market is ascribing some sort of a premium on the valuation of the company. And by premium, in relative to the S&P 500, it's actually the top 500 companies in the index. So it could be because of a whole host of reasons, like economic moat, the stickiness of the earnings, etc. So the second way to compare it is to look at its industry peers. And that would probably provide you with a much fuller context on how the market is looking at the specific quality of the company or security at hand. So to give you a very quick example, so both Intel and TSMC is in the chip making industry, not barring the fact that there are nuances between both companies, where one just produces chips while the other does both designing and producing. So at the time of this recording, Intel has a PE of around 9, while TSMC has a PE of around 14. So we can continue this discussion in the comments on why there is this disparity between two seemingly similar companies in the same industry, but I hope that you kind of understand what I mean by comparing to its industry peers. Now, this is a quick and lazy way to judge the valuation of the company, but it doesn't take into account many other factors, like future expected growth of the earnings and the reliability of said earnings when you project forward. Let's not forget that the denominator of the PE ratio is the E in PE, and it is the trailing 12 months earnings. So it's essentially providing you with a snapshot of how the company did in the past 1 year, trailing 12 months of course. That said, the market is forward-looking in nature, so here we introduce the new contender called the forward PE. So like the name suggests, it attempts to provide you with a forward projection of the company's valuation based on the expected or the guesstimates of the forward earnings per share in the next 12 months in relation to today's stock price. So if we were to look at the three stocks that were mentioned in my tweet again, so Alibaba had a PE of 117, while its forward PE is at 12. Amazon had a PE of 86, with a forward PE of 46, while Tesla had a PE of 55 and a forward PE of 36. Now, let's try to explain the variances in the PE ratios amongst the three companies. So I'll try to do the most controversial one first, Tesla. So I think Tesla's high PE is warranted. The assumption now baked into the valuation is that Tesla is able to continue growing at a relatively quick pace. And by quick, I mean at least 40 to 50% in the next 1 to 2 years. So of course, skeptical investors will beg to differ. But you cannot deny on how Tesla has executed thus far. And they've executed a 50% growth in the last 1 year. So if you were to apply a 50% growth rate on the earnings, the PE ratio will drop from 55 to 36 in 1 year. And if they maintain another 50% growth in year 2, the PE ratio will drop from 36 to 23. It's just simple math. Essentially, markets are ascribing a premium on Tesla's valuation because many investors are confident that Tesla can deliver such growth, and assuming that valuations stay flat for 2 years, the PE ratio will normalize to what the general index is doing at 23. But that's assuming that the market doesn't bid up Tesla's valuation in that same time period. Now, moving on to Amazon. Amazon is a special creature. If you were to observe the PE ratio trend of this mystical creature, it is common knowledge that Amazon tend to trade at a relatively high valuation for the last decade or so. So you can see that since 2010, Amazon trades as a PE of between a range of 50 to 100, notwithstanding the periods where they had negative earnings, so the PE was essentially zero, or some of you might call it infinity if you want to be more specific. So for Amazon's case, it's more specific to their business model and essentially management's philosophy. So long story short, Amazon's management is trying to artificially suppress the earnings of the company via many levers. So firstly, they can pass cost savings to the customer, thereby hitting both their revenue and also their bottom line net income by passing on cost savings. So secondly, they also engage in heavy R&D, which is more often than not expended away rather than capitalized. So in order for you to have a clearer picture of Amazon's real valuation based on the PE ratio, you probably need to clean up their financial statements yourself and don't take the 80 PE at face value. So the PE ratio here is not useful because the earnings is artificially deflated. Lastly, our all-time favorite, Baba my Abba. Essentially, Alibaba's recent earnings have been severely impacted by the conditions of the market. So it was stated in the quarterly financial results in the footnotes section to explain the net income loss that was projected or reported. So the year-over-year change was primarily attributable to an increase in net losses arising from the decrease in market prices of our equity investments in publicly traded companies and a decrease in share of results of equity method investees, partly offset by an increase in adjusted EBITDA. So to explain it in English and not the mumbo-jumbo financial jargons that they used in the report, Alibaba essentially run an investment arm of their own, where they make up of positions in other companies, regardless of whether they are public or private companies. So according to the accounting standards, they're required to both write up or write down the value of their investment portfolio whenever there is huge fluctuations, and it will flow into the net income statement of Alibaba. And in this instance, at least in the last quarter, Alibaba had taken a huge hit on the net income level, which explains the evaporation of EPS. And not only did it evaporate, it was essentially pulling down the trailing 12-month EPS due to the loss, which caused the PE ratio of Alibaba to moon. And because of this writing up or writing down of Alibaba's earnings, you can see that there is actually a huge fluctuation in their earnings in the last decade or so. Hence, it is probably more accurate to focus on Alibaba's operating income and also Alibaba's free cash flow, which excludes the shenanigans going on in the investment side. So 3 different companies, 3 different PE profile. And I hope that in future, you wouldn't buy a company just because it has a low PE ratio. With that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!